If you've been having a look at the charts in your trading platform, you must have surely noticed there are multiple time frames that you can choose from and that you can be trading on. Each chart has its own function, its own purpose, and should be used in a different point of trader's journey or at a different time during a trade analysis. When you're starting out, it can be pretty difficult to choose which time frame to work on, which charts to look at, so I'm gonna try and make it a little bit easier for you. So let's not waste any more time and let's get right into it. Ideally, you would be using more than just one time frame for trade analysis, for finding entries, etc, etc. And there's a lot of reasons to be using multiple charts, but we'll go through each of them and their purposes, and then at the end we'll look at how to do multiple time frame analysis. Time frames can be incredibly confusing, and you'll often hear when starting out that the short time frames are impossible to trade profitably, which isn't exactly true. All time frames have their purpose, and they ideally would be used in conjunction with each other to give you as much information as possible. If you're only trading by looking at a single chart, you're missing out on a lot of information. Therefore, let's get that out of the way right in the beginning. There's no best time frame to be using in your trading. They all have their purposes. Depending on the type of the trader you are, there are going to be time frames that you're going to be using a lot more than others. But for a good trader, you should be able to use all of the time frames, and ideally, to achieve consistency, all of them will be woven into your trade analysis. That is the approach that most of our traders use. So let's separate time frames into different categories and have a look at them and what their purposes are. All right, we're going to start with the scalping time frames. So I'm going to talk about the 1 minute, 5 minute, and 15-minute charts. Those are the ones that are used most often. These three time frames are often known as the time frames that scalpers use most often. That is because the candles move very fast. As for example, with the 1 minute chart, every minute you get a new candle. Therefore, you can see patterns emerging pretty quickly. Same goes for the 5 and 15-minute charts. They're all charts that provide information very quickly. And that means that on these charts, there are more trading opportunities presented each day, therefore giving you more opportunities to trade, and that can potentially lead to higher profitability. However, they have a certain disadvantage, and that is the fact that if you're going to be trading primarily on these lower time frames, you're going to need to spend a lot of your time in front of the screen. That is because while there are more opportunities during the day, they also last much shorter time. So even taking a bathroom break on a 1 minute chart could lead to you missing out on an opportunity. And what a lot of beginners do is when they miss out on those opportunities, or they saw that an opportunity just happened, they'll get into the trade anyway, even though it's not following their strategy, their plan. They have such strong fear of missing out that they'll jump into the trade anyway. So it is really double-edged sword trading on such short time frames, because yes, there are a lot of opportunities, but there's also a lot of danger and a lot of potential for quick losses. But not to bash on the scalping time frames, it's absolutely possible to be a profitable trader trading on the shorter time period. You just have to be aware of your emotions, and they are also useful for traders trading on the higher time frames to pinpoint where they're gonna enter. So you might be using a 4-hour and 1-hour chart, and then using maybe the 15-minute chart to just pinpoint your entry. It's one of the ways that it could be used. The second category that we have is, just as I mentioned, the intraday charts. We're going to be talking about the 30-minute and the 1-hour chart here usually. They are much slower than the lower time frames. That is also, once again, an advantage and a disadvantage at the same time. These time frames are typically much what we would call clearer, because there is not that much noise in them as is in, for example, the 1 minute chart. The 1 minute chart is not a clear chart. There's a lot of trading noise. The 30-minute and 1-hour charts take a lot of that away. But at the same time, they are still pretty short time frames, so they present a good amount of opportunities each day. The number of pips that you're going to be looking for your stop losses and take profits is also going to be higher than on the scalping time frames here. And once again, depending on the primary time frame that you use, the 30-hour and 1-hour charts can be used as entry points for the higher time frames. And as with any time frame, it's best to use these charts in conjunction. Our third category is the swing swing trading timeframes. It's going to be the 4-hour, the daily, and the weekly. Now, the 4-hour is often used by intraday traders. It's on the border between swing and intraday trading, so you could really place it into any of those categories, to be honest. But talking about these timeframes in general, they're much slower than the 1 hour, the 15-minute, 1 minute. Therefore, they are once again much more clearer in terms of trends, in terms of where the market is going as a whole, and they're going to provide less opportunities. But the advantage of them is that you can trade while not spending that much time in front of the screen. Yes, you're going to have fewer setups each month or each year, but it takes a little less time for analysis, and when there is a window of opportunity, it usually lasts a little bit longer. Now, due to the time frames being so large, this is where we're going to start seeing the real influence of the underlying economical factors. Therefore, traders looking to trade primarily on these charts are going to need a good understanding of the fundamentals of why prices move, what news move them, and what are the reasons for where the market is going, what are the current trends. You're going to need a lot of that fundamental information to make good and informed decisions while trading on these higher time frames, because that's what they are primarily affected by. And these time frames, they work really great for following market trends and market bias. If you are trading on shorter time frames like the 1 hour or the 30-minute, these provide a really good way for you to see, hey, what is the market doing in the long term? Also, I would like to point out that these time frames are good for beginners because they move slowly, they give you that time to decide, they don't pressure you into anything because the opportunity is still going to be there. You don't have to spend your whole day in front of a screen, and it's a good way to learn about the markets. It's the same as riding a bicycle. You start slow and you get fast later. I think it's the same with the markets. Starting on the higher time frames tends to be a little bit easier. Also, what I see as a benefit for beginners is that on the higher time frames, even if you're gonna have losses, it's gonna take you longer and you're gonna have more time to learn in between. And then our last fourth category is the positional trading, and there we're gonna be looking at monthly and higher charts. These charts are good for building a picture of like where the market is going in general, but when it comes to trading, we are usually not thinking about using them as traders for our entries at all, because you're only going to have 12 candles each year, and that's usually not enough to build a trading setup. And even if it is, the trade is going to take so long to play out that you need significant amount of capital for it to be worth it. And I know that most of you watching probably are not managing funds of hundreds of millions of dollars. So we are generally not going to be using the monthly charts to build any trading ideas, but it's a good way to see what the market is doing in the very long term, like where you can see it going later in this year. It's also helpful for swing traders to basically just build an idea of the overall market trend in the long term. All right, so in my experience, and I think in the experience of majority of traders, the approach that you really want to be taking is to analyze using multiple time frame analysis. For example, a bullish trend might look really strong on a 5-minute chart, but then you look at the 4-hourly chart and you see that you are in a more long-term downtrend, and that is gonna make your idea invalid. Therefore, using multiple time frames is gonna provide us with a better idea of what's really going on in the market, because using just a simple one time frame, you're focusing too much on just a certain piece of information. You're not looking at the whole picture. So in summary, you're gonna find the time frame that you are gonna be using most frequently pretty much on your own. You're gonna see from experience which time frame you feel the most comfortable in, but the one thing I want you to take from this video is don't just use a single time frame for your analysis. Go from the top down. Look at what the market is doing on the weekly, the daily, the hourly, and only then look for your entries on the lower time frames. I think that is going to be the best approach for most traders. Thank you for watching this video. I hope you learned something, and if you want to get in touch with us, feel free to leave us a comment in the comment section down below, or have a look at the contact page in the description. We also have a 24/5 live chat if you want to get your answers quickly. My name has been Oliver. Thank you for watching, and have a great one.